Want to invest in a business that looks like a coiled spring ready to explosively uncoil? Looking for a yield that beats the market and dividend growth that beats inflation? Like the idea of buying shares on deep discount after a stunning 40% drop in price? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Feber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before we get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a major manufacturer for automakers. Vehicles have been breaking all kinds of price records over the last couple of years. Why? It's simple. Comes down to supply and demand. Extremely high demand has simply not been met by supply due to all kinds of issues with the global supply chain. But as these issues start to resolve over the next few years, this business can bring on more supply and see an explosion in its revenue, profit, and dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Magna International Inc., which appear to be trading at a significant discount today. Magna International Inc., stock ticker MGA, is a multinational mobility solutions and technology company for automakers that designs, develops, and manufactures automotive systems, assemblies, modules, and components. Founded in 1957, Magna is now a $16 billion by market cap manufacturing Goliath that employs over 160,000 people. Fiscal year 2021 revenue can be broken down by product category. Body exteriors and structures, 40%, power and vision, 31%, complete vehicles and other 15%, and seating systems 14%. Based out of Canada, Magna is one of the world's largest manufacturers of OEM components for various automakers. Yes, it's large, but Magna is also broad. Magna is so broad, in fact, that it could practically be its own car maker. Morningstar elaborates on this point, and I quote, "Many suppliers focus on a particular area of the vehicle. In sharp contrast, Magna's capabilities are so broad that the firm could nearly design, develop, supply, and assemble vehicles all on its own." Unquote. We know two things about mobility. It's becoming more pervasive and it's becoming more complex. Companies left and right are getting into the mobility game through EV and self-driving efforts. Simultaneously, vehicles are becoming increasingly reliant on technology. All of this plays right into the hands of Magna. Any company that's trying to quickly scale up in mobility is naturally going to consider partnering with a capable manufacturer like Magna. And the more complex a vehicle becomes, EVs are a prime example of this, the more imperative it is for the manufacturer to be technologically adept. In a world that demands more mobility and more tech, Magna is up to the task. And that bodes well for the company's growth as it relates to revenue, profit, and the dividend. Already, Magna has increased its dividend for 13 consecutive years. The 10-year dividend growth rate is 12.7%. That's solid and it easily beats inflation. Plus, the stock yields a market-beating 3.2%. That's a heck of a combination of yield and growth. By the way, this yield is 60 basis points higher than its own 5-year average. And since the payout ratio is 45.3% based on trailing 12 months adjusted earnings per share, we have a well-covered dividend. I like dividend growth stocks in what I call the sweet spot, a yield of between 2.5% and 3.5% paired with a high single-digit or better dividend growth rate. The yield is on the high end of that range, and the dividend growth rate is well above what I'd look for. Extremely sweet. Looking at business growth, Magna has advanced its revenue from $30.8 billion in fiscal year 2012 to $36.2 billion in fiscal year 2021. That's a compound annual growth rate of 1.8%. I usually look for a mid-single-digit top-line growth rate from a mature business like this. Did Magna disappoint me on this front? Not really. The business has been severely impacted by pandemic-related lockdowns and the corresponding kinks in the global supply chain. Revenue is still not back to where it was in fiscal year 2019. Meantime, earnings per share grew from $3.04 to $5 over this time period, which is a compound annual growth rate of 5.7%. Better, but not great. Again, the business has been directly and negatively impacted by the unfortunate events of the last 2 years. If, for instance, we back things up and look at the 5-year period from fiscal year 2012 to fiscal year 2016, earnings per share sported a compound annual growth rate of over 14%. So it depends on when you're looking at Magna's results. We are starting to move past the pandemic, so this impact from this temporary shock to the business will start to abate. Over the next few years, Magna should recover with meaningful growth off of this artificially low base. I will note that a lot of the excess bottom line growth has been driven by share repurchases. For perspective on that, the outstanding share count is down by 36% over this 10-year time frame. That's substantial. Looking forward, CFRA believes that Magna will compound its earnings per share at an annual rate of 17% over the next 3 years. I said that Magna should recover with meaningful growth. Well, that would be very meaningful. I would ordinarily be leery of this kind of forecast, but I think it's actually quite reasonable in this case. That's because I see the business as a coiled spring in some ways. Magna has been forced to operate at a compressed, suboptimal level for more than 2 years. As the kinks in the global supply chain become corrected, however, the coiled spring should explosively uncoil. Record low inventories for new autos are coming at a time when demand is at all-time highs, which has led to record high prices. Supply doesn't have to just catch up to 2022's demand, but also make up for the pent-up demand that's been building over the course of more than 2 years. Simply put, there has been not enough supply to meet demand. CFRA states it best here, and I quote, "Sales would be stronger if not for the record low inventory levels and parts shortages, particularly semiconductors, which have plagued the market in recent months," unquote. The need for supply to catch up to demand obviously bodes well for Magna. CFRA adds this, and I quote, "On the positive side, economic growth, low unemployment rates, and relatively low but rising interest rates should help support sales volumes. We think margins will benefit from a combination of record high new vehicle price realizations, over $47,000 in the US as of May 2022, and cost cuts implemented during the course of the COVID-19 pandemic," unquote. Magna does have certain idiosyncratic challenges, including impairments relating to Russian operations, but the setup here for the next few years is about as good as it can possibly get for Magna. While dividend raises could be modest over the next year or two due to so much uncertainty, I would expect a nice acceleration in dividend growth once the global economy gets on more sure footing. This would allow for the payout ratio to remain healthy in an environment where lesser companies would have had to cut the dividend. Once we get past the next year or two, a return to double-digit dividend growth may be back on the menu, and when you're already starting off with a 3.2% yield, that's a compelling package. Moving over to the balance sheet, the company's financial position is solid. The long-term debt-to-equity ratio is 0.3, while the interest coverage ratio is 17. The interest coverage ratio is already really good, but it should improve once EBIT rises as a result of operational normalization. In addition, there's almost enough cash on the balance sheet to offset all long-term debt. Profitability is certainly adequate, but I think it can and will improve further. Over the last 5 years, the firm has averaged annual net margin of 4.2% and annual return on equity of 15%. Magna is a fine business that's positioned to become even finer over the coming years. And with economies of scale, barriers to entry, and switching costs, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. The company does have exposure to Russia, and the most recent quarter included a large impairment charge related to Russian plants. Input costs are highly volatile. Magna has customer concentration risk. Its 6 largest customers account for nearly 80% of annual sales. There is direct exposure to economic cycles, and this risk is amplified by the capital-intensive business model. The current kinks in the global supply chain could take longer than anticipated to resolve. Constant technological changes in mobility introduce the risk of Magna being left behind. These risks are valid and worth carefully thinking over, but the business still strikes me as appealing for long-term investment. The 40% drop in price from the 52-week high, which has created a favorable valuation, makes it that much more appealing. The price earnings ratio is 13.7 based on trailing 12 months adjusted earnings per share. To be fair, Magna typically gets a relatively low earnings multiple. However, even by Magna standards, this is noticeably undemanding. Its 5-year average PE ratio is 15.2. We can see that the price to sales ratio of 0.4 is slightly lower than its own 5-year average of 0.5, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. In my view, this is a balanced and appropriate long-term expectation of dividend growth. This is quite a bit lower than the demonstrated dividend growth over the last decade, but the truth of the matter is that earnings per share growth hasn't kept pace. On the other hand, CFRA's near-term earnings per share growth forecast would allow for the dividend and earnings per share to come into better alignment. With the payout ratio being so moderate, Magna could afford to hand out good-sized dividend raises over the foreseeable future, with room for further acceleration in dividend growth down the line. The dividend discount model analysis gives me a fair value of $64.20. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Magna as a 4-star stock with a fair value estimate of $83. CFRA rates Magna as a 3-star hold with a 12-month target price of $60. I came out closer to where CFRA is at, but we all see undervaluation here. Averaging the three numbers out gives us a final valuation of $69.07, which would indicate the stock is possibly 27% undervalued. Here's the bottom line, guys. Magna International Inc. is a leading manufacturer and supplier in mobility. Supply needs to catch up to demand, which means the business could be a coiled spring ready to explosively uncoil to the upside. With a market-beating yield, double-digit long-term dividend growth, a moderate payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 27% undervalued, this could be a fantastic long-term opportunity for dividend growth investors. And now for a special news announcement. Albemarle Corporation, stock ticker ALB, just released Q3 earnings. All I can say is, wow! Revenue is up by 151.6% year over year. Adjusted earnings per share came in 614% higher than last year. Yes, 614%. Year-over-year bottom line growth. In my view, Albemarle is the way for long-term dividend growth investors to play lithium. I've covered this name numerous times on the channel before. Don't forget about this fast-growing dividend aristocrat. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.